their fair value area. And it's the same cycle.
I'm coming.
Then the intermediate tomorrow is not protected, and that actually becomes the target instead.
That is the voice of Arjo.
Yes, I was
That
watching
is
a video when you
all
said you.
right. All right. He's a very, very, very good mentor. So, from where I stopped, like I was saying. But let
Okay.
me first go over what we'll be
Yeah.
talking about today. We'll be talking about how to identify a trend. How to identify a trend. When I say how to identify a trend, I mean how to know that when you are buying, the trend is actually bullish, or when you're looking to buy, the trend is actually a bullish market. And when you're looking to sell, the trend is actually a bearish market, if you understand me. So, I'm going to go over the way you're going to be identifying a trend and reversal. Then I'll be identifying a retracement as well. When to know the type of retracement. Is this a small retracement? Is this a deep retracement? All right. Because sometimes market might start retracing for a long time. You will think we have now changed direction, but all of a sudden it will start buying ahead. So we are going to talk about retracement. We are going to talk about positioning and management of a trade. That is how you enter a trade, and then when you're in the trade, how you manage it, what you should do, what you shouldn't do. All right. So I'm going to be showing you my Fibonacci system here and the patience mechanism. Patience mechanism, there are a lot of things in it. One of the things in that patience mechanism is uh, waiting for your trade setup. All right. Waiting for your trade setup and what you should be doing while you are waiting. It's not enough to just be waiting and maybe you just leave the forex one side open one day. When you open it, you be city setup. Every day you will be showing up to the market. You understand? Every day you'll be attentive. You may not even have trading days for like 3 days, no setup. All right, you will just still be attentive. It shows you are waiting on the market to provide a setup. You understand me? So
Yes.
let's go. I'm gonna start with the top down analysis like I always do. So on this monthly time frame, this is the previous month high. I've marked it as my internal ITH, internal um trading intermediate term high, sorry, my intermediate term high, while STH is my short term high. All right. Now, like we said earlier, the reason why I mark this as an intermediate term high, we'll talk about it shortly. All right. And that is what is going to determine the trend as well. We're going to use that to determine the trend. Now, I need you to write down something. Now, a short term high, trying to move this. Hold on, please.
This is your biggest this is my like I mean your strength.
Uh, my screencast. Let's see. Share screen. How about now?
Okay. Better.
You can see it now.
Yes.
It's bigger now. Okay, F11.
Yes.
All right, good. A short-term high is only confirmed by the creation of a fair value gap within it. And when two short-term highs have been confirmed, the market is likely going to keep that direction or trend. I'm going to explain this. Two short term highs is equal to the creation of an intermediate term high. Now, I am using this in a bearish scenario, right? In a bearish context. Sales or short. Are you following?
Yes, sir.
All right.
Yes, sir, we do. Yes, sir. I'm done. Okay.
We are done.
Yes.
All right, good. So now, this is the monthly time frame, but something is being indicated here. ITH, intermediate term high. Why we have been able to mark our monthly time frame high, this over here is our monthly time frame low. This low, but we are not going to be. It has already been traded into that low. All right. So we're just
Okay.
gonna, yes,
Yes.
this candle has already traded below it. So this is how you look for trades and how you identify a trend. First things first, this is the monthly time frame. We have marked our high, low has been used, so we remove that one. We now go to our weekly time frame. On the weekly time frame, what do we see? I'm using US30 as an example. If you come to the US30,
Okay.
there's a fair value gap here, but it's a very tiny fair value gap, but it's
Yeah.
there, as you can see. This is a fair value gap, but that's not what I'm to be showing you.
Yes.
Now, this is how I want to show you. How do you know that you should be buying or you should be selling? How do you identify a trend? To majorly identify a trend, the work starts on the bigger time frame. But for easy catching up and easy identification, quick identification, we are going to be using the daily time frame. All right, the daily time frame
Okay.
to identify the immediate trend. We have overall trend and we have immediate trend. All right, we have overall trend, we have immediate trend. Now, the overall trend now on US30, if you ask me, coming to the monthly time frame, this is monthly time frame, all right? Now, count with me from this white candle. This is one, two,
Two,
three,
three,
4, 5, 6,
five, six,
7,
seven,
8,
eight, nine,
9, 10. Do you know how
yeah.
many monthly candle that is? That is 10 monthly candle. If I add these two black candles, that is the whole of 2025 or almost the whole of 20. That's 10 candles. All right. We are in the third
Yes.
month of 2026. So one, two, three. This is where January started from. This white candle. Now this is March.
Okay.
This is black candle. What does that tell you? Almost the entirety of last year was bullish on US30, as you can see, right? It was buying and buying. Every
Yes.
month kept on buying. Every month kept on seeking the previous month high. And that is how a trend should be. Unless a fair value gap has been created, price will always seek its previous candle high to continue in the bullish market. but continue the bullish trend. And that is what we have here. You can see if I draw this trend line, does the trend line face down or is facing up? It is growing up, right?
Oh,
It is not growing down.
yes.
That means we are in a bullish trend. So on the monthly time frame, can quickly show you the kind of overall trend that you are in. In this case, on US 30, we are bullish. But from last month and this month, markets have started falling, right? Some people may not catch this fall early, like myself. I didn't catch it early because I was still looking for buys because it sold throughout last year. So at least this year, it should sell a little bit before maybe continuing, maybe ending of the year or middle of the year. Sure you get. So now, like I was saying, if you go to your daily time frame, what did we say about a short-term high? Here we said a short-term high is only confirmed by the creation of a fair value gap within it. Good. Now, let us identify a short-term high on this market together. All right. When this market, all right, when GBP USD, sorry, when US 30 was buying and buying, yes, what were we creating? This is a fair value gap. This gap, this hole right here, that's a gap.
Yes.
You can see it, right?
Yes.
Where do we have a gap again? There's a gap here. You can see it, right?
Yes.
That's the gap there. Good. After this gap was created, now these gaps, these these fair value gaps, their low is usually a short-term high, or a short-term low. So this gap here was a short-term low, right? Because this is a bullish scenario. Look, it's like this. Once you have a bullish fair value gap, you will have a short-term low. Now let's write that together again. Once you have once you have a bullish fair value gap, you have a short-term low. Once you have a bearish, what are you going to have once you have a bearish fair value gap?
You have a open high.
That's very good. A short-term high, and that's that. You have a short-term high. Good. Now we can count these three bullish candles. Candle one, two, three. There's a gap in it. Short-term low. Now this candle
Please,
tapped into what?
just a minute. Just a minute.
Okay, all right, all right.
Okay.
All
Hold on.
right, all right, all right. Good. So now, like I was saying, you remember? Let me remove this circle so I'll use a box. It was box we were using that time. You remember when I said if you want to draw a bullish fair value gap, you draw it from the high of the first candle to the low of the third candle. This is a bullish fair value gap. Where's the first candle? This white one, because it's a three candle pattern. One, two, three. White candle. The first one is the high. Then this is the third candle, the low. And there we have it. You can see as price came back into it and went back up, right? Good.
Yes.
So this is a bullish fair value gap. And when price did this, price created another fair value gap, a tiny one over here. Alright, that's another fair value gap inside here. It is there, but it is
Yeah.
small, so it is not very visible. But it is there. As you can see, the third candle low does not overlap with the first candle. That means it's a bullish fair value gap. So at the end of the day, even this one is a short-term low. Again, alright, short-term low. And listen to me, all short-term lows will continue holding until price have now decided to start a reversal. All right, until price have decided to start a deep retracement or reversal. Now let us come to current price. As you can see, all this area with fair value gap, 1 2 3, all these candles, all this range with fair value gap, they are low, were holding. Price was not trading back to the low. Once price get there, somewhere around here, price will bounce. Somewhere around here, but it was not coming back to this low. So if maybe price fell and you bought anywhere around here, you would have made some profit. You understand me? But now,
Yes.
as we can see, now after price, sorry, excuse me, after price bought all the way up to this high over here, what did it start doing? It's our last um over here. It's our last bullish short-term high. When price got here, what did it do? Price created a what? A bearish fair value gap. What I'm trying to do now is teach you how to identify trend though. You will soon get what I'm talking about. A bearish fair value gap. When price created this fair value gap, it was fair value gap 1. Abi, this was the first one to be
Yes.
created after price got to this area. Then moving
Yes.
downward, what did price do? Price created another one. Where? Here.
Mm.
That is after trading into this one. As you can see, price came into the gap once and twice, and then it created another one. So this first move downwards is a short term high. All right. You can see, but this was the first
Yes.
fair value gap that was created. So it was the first short term high. As soon as this second fair value gap has been created, this high becomes intermediate term high.
I think I've seen the video.
You watched it,
Uh,
yes, yes.
yes.
As soon as this second one is created, this high becomes an intermediate term high. Then what does that tell us? It tells us that price can now start seeking the short-term lows of the previous trend. All right, this was the previous trend, buy, 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 and the short-term low, short-term low, short-term low. Where's the next short-term low? Here. Where is another short-term low? Here. There's another one here. Price has taken this one. But this is the beginning of the entire move here. So as you can see, in how many moves, price took out how many short-term lows? One, two, three, almost 4 short-term lows, all right? After creating short-term high 1, which is now the intermediate term high, and short-term high 2, which is over here. Okay? So now, once you are what you are doing now is you are waiting to see where did the market last create its most recent short-term highs or short-term lows. You understand? Which means where did the market create its most recent fair value gap on the daily time frame like twice? Do you understand me?
Yes.
Once you have confirmed that okay, there's a short-term high here 1, there's a short-term high here 2, you cannot anticipate a third short-term high to form that okay, the market is going to continue down. All right, look at this. Let me use a vanishing tool. Good. When price kept on created this bullish fair value gap, we kept on buying. When price will now create this bearish fair value gap, you first pause to see whether price will take over this fair value gap. Maybe price will do like this, come into it, come down, then continue up. All right,
Yeah.
we'll first
Okay.
pause to see what will happen so that we are not wrong on direction. But immediately we see that price did not go back up. Instead, price came into it, came down, came into something around here, and in coming down, it created another fair value gap that it used to come down. What should that tell you immediately? That should tell you that the market is about to start a very deep retracement. Do you know the meaning of a retracement? A retracement means once a market is going up, normally it will need to rest for a little period. That resting period is called a retracement. For example, market is buying, is going up. This move upward is called the impulsive move. Then it will come down small. This small move that comes down is called a retracement. All right. Then it will do what it wants to do. Maybe play around, play around, play around. Then it will what continue up again. This up that is continued is called impulsive move. Then it will come down again to look for to offer fair value. It will then continue up again. So as you can see, this first move up is impulse. The one down is retracement. Up impulse, down retracement in a bullish scenario. So now if you check, since that price have created this bearish fair value gap one, you don't know we don't
Yeah.
know whether it wants to continue up or it wants to start going down. But when is it confirmed that yes, this market would like to start going down? It was when price created this fair value gap over here. You can see it. And as it created this fair value gap, this high automatically became a what? A short term high. Now that is how you identify a trend. Once by 3 days, this is the daily time frame. So if 3 days creates a gap inside it, that high should be protected. That high is a short-term high. Price will keep protecting that short-term high until it has come to take out enough liquidity, or it has come to take out the intermediate term low. Okay, so on US starting now, we are a little bit bearish. Now, what are you looking for? Like I said the first time, you are looking for fair value gaps. You need to know how to spot and identify fair value gaps. Okay, fair
Yeah.
value gaps. Good. Now, we were able to identify this fair value gap on US 31. We were able to identify this fair value gap on US 32. Once these two fair value gaps have been created, the high of the first one, that is one. The high of the second one,
Yes.
that is two. That is two short term highs. Then the first one automatically becomes an intermediate term high because it has the power, it has the impulse, it has the volume to be able to create two short term highs, which means a long period of what? Of selling. Immediately that happens, you become bearish. All right, your idea now shifts. You are looking to follow the new creation of the third term high. Now, once you see that price has created a fair value gap, what do? You go to your 4 hour time frame to look for what? To look for structure. What should that structure look like? Remember that this is a bearish fair value gap, right? So we are looking for a structure that is going down. All right. So something that basically looks like this. All right. Good. Now let us go to our 4 hour time frame. Seeing that price has created two short-term highs, it means we now want to start selling. We could continue selling. Good. When we go to our 4 hour time frame, I will use this our part two, all right, to draw. Mind you, we are working with this fair value gap or this daily fair value gap. Okay, good. The reason to come down, go up, come down, go up, come down, go up, come down, go up, come down. You can see how the market was just waving and waving, but it was still going lower. You can see that, right?
Yes.
All right, good. Now, when you see a structure like this, you are bearish. Number one, you have confirmed that the daily has two short-term highs. You have confirmed that there is a current fair value gap on the daily that have not been mitigated, that has not been traded into. Then what do? You understand that okay, this second short-term high may lead to a third short-term high, which means we may eventually continue going down. What will you now go to the forward target to look for? To identify your structure, something that looks like this. All right, so good. This 4 hour, this a daily fair value gap that is here. What does it leave us with? It leaves us with a structure. What was the most recent structure? One, two, three, four, five. This was the most recent structure. All right, so now, how do you position on a sell trade after seeing your structure? Okay, that is where we want to work on now. Now, I will need you to jot something down. Now, on the 4 hour time frame, when price creates a structure that aligns with the daily time frame FVG, price can always retrace back to two places before continuing. Number one, fair value area stroke reaction POI. Number two, origin POI, which could potentially also be the order block. All right. So if you are done writing, you let me know.
Okay.
All right.
Okay, I'm done.
All right. You're done.
Yeah.
Okay. Hold on.
This particular session, they on screen record, abi?
Yes.
Okay.
So we're done with this, right? Let me overlap them.
Yes.
All right.
Okay.
Good. Now, as I was saying, once you just see that on the daily time frame, you have a fair value gap very like this. That means you already have a trade idea. Okay. What you do is on your 4 hour, you just go to your 4 hour time frame. Baga. Identify all the short term highs on the daily, first and foremost, so that you know where should be protected and where should be run or where price should head to. Now, on this daily time frame, we see price create the first bearish fair value gap. One, we see price create the second one. Two, that one automatically tells me that price may want to do what? Come into this fair value gap and continue lower. Now, it doesn't necessarily mean it will come into the fair value gap, but the confirmation is stronger if it comes into the fair value gap and it looks like it wants to go lower. Then you know that okay, there's a higher percent that it will go lower. But currently, the fact that price can create a fair value gap tells you that the move downward is strong, all right, and there's likely sellers in that market. There's likely the the intention to sell. So as you see the fair value gap, you go to your 4 hour time frame, you look for what? You look for structure. Now this was the fair value gap that was created, all right, but price did not trade back into
Yes.
it. But what structure was available before I was able to catch that sell? This was the structure, all right. Good. Now, like I said in this other one, I said on the 4 hour time frame, when price creates a structure, this is the structure here, all right,
Yes.
that aligns with the daily time frame FVG. Price can always retrace back to two places before continuing: the fair value area or the reaction POI or the origin POI and under block. Now let us mark out our structure chart. We have our what? Our fair value area over here. You know how to pick your fair value areas, right? From our previous
I know how to.
how to draw it. When
I
price,
know, like I can identify fair value gap, but this one that you draw now, like
fair
am I
value
supposed
area,
to draw it to this end?
I will explain it to you.
Yes.
I will explain fair value area to you. Look,
Okay.
look at this part now. If price is buying, what did I say it's going to do? It's going to create impulse, retracement, impulse, retracement. Abi? Impulse,
Yes. Yes.
retracement. Good. Now listen to this. When price creates an impulse, all right, and then it creates a retracement, the high that it left behind to create that retracement, once price breaks that high becomes fair value area. Okay,
Okay.
so in a bullish market, this high was what was broken in this bullish pattern right here, and this becomes a fair
Okay.
value area. Fair value area. Now, if you twist this upside down, that is this bullishness, if you swap it to bearishness, what is it supposed to look like? Once price is coming down, right? The low, this
Yes.
low that it will leave. This is an impulsive move down, a retracement move. This low it left behind. When it breaks it again to go lower, that low becomes a fair value area. All right, a
Yes.
fair value area. So price can either retrace back to this line because that's a very strong sensitivity area. Price can either retrace back to this line or retrace back to origin. Okay, now let me show you where the origin is. The origin simply means the beginning of the impulsive move. All right, the beginning of the move. Now let me use a tool. Now when price broke down like this, it broke this high. What move started? What area started this impulsive move down? Is it not this high?
Yes.
And this impulsive move down, what high started it? This high.
Yes.
Good. So every high that starts impulsive move, there is likely going to be a sensitive area or a strong order there. You understand? That price will retrace into, take the order, or price will retrace into and continue selling from there. Now, in this very scenario, we'll mark out the origin like this. And what will we mark out again? We'll mark out the reaction. Now, let me explain reaction POI for you. Before price breaks this low, okay, this low, when it's trading down, before it breaks this low, Sometimes price will do something like this. All right, price will go up, break down, go up again. Now to come and break down, it may do something like this. Break down, up, down, up, break down. All right, these are the market moves. Oh. Very crazy sometimes. Now let's start from here. Let's start from here. When you see price break down like this is fair value area. Small reaction will happen, like small consolidation or a little bit of buying pressure that we feel. But a small reaction will happen before price will break down. That reaction, that area of reaction is called a reaction POI or a reaction point. All right, because this area was wanted to serve as a support to continue that buy, to help the buy to continue up, but something came in into that market at that instant and now pushed it down. Okay, some sort of impulse, pressure, or volume came into the market that pushed it down. That impulse, that area of impulse is what we call our reaction area. I will show you on the chart. So like I said here, there are two places before continuing. Reaction area, which is always or usually close to the fair value area. That's why I didn't say three places. Sometimes your fair value area will be in line with your reaction area. So your reaction area, your fair value gap, and your origin. Where's the origin? The beginning of the entire move. Okay, so you will see something like this, which is the beginning of the entire move, right?
Yes.
Okay, good. Now let's go to the chart on the 4 hour time frame. Don't forget what I said here. One, fair value gap area, fair value area. Second, reaction POI. Let's not forget what I said here. Yep, because I'll talk about it now. Okay, good. Now let me recap. On the daily time frame, we see that we have what? We have this fair value gap. Price has not traded back into the fair value gap yet, but you will have to go to your forward time to see if there is a structure. I go to my forward 4 hour time frame, and most definitely there was a structure. What is that structure? This right here. One, two, three. That was the structure to show that price is going down. And what the price break? What low the price break? Can you see it? This is the low
Yes.
that it broke to come down like this. All right. And when it
Yes.
came back up, what low did it break again? This low, right? Good. Every time price breaks a low, it creates a fair value area. It is that fair value area that is responsible for price to continue your direction sometimes. All right. So good. Now, this fair value area that has been created, we see price head towards it, tap into the fair value area. Then what did it do? It created more fair value gaps downwards to continue in its direction. Watch. We have this structure. One, two, three. Are you with me? And then price trades back up into this line. It can go above it a little, but price trades back up into this line or above it a little. One. Then what did it do? It broke. It broke down again over here, as you can see. Then what did it do again? It traded back up into here. That was where I caught the trade. All right, I caught a trade here. Now let me show you the breakdown of that trade. As price created this structure, there are two places it can retrace into before it continues direction. Number one, fair value area or reaction area, or the origin. Now let us look for the reaction area of this setup, of this pattern that we have here, because I I used a uh, I used the reaction area POI for this trade. Okay, so let me delete this quickly. Now watch. Price moves up like this, it breaks down. Can you see there is a small reaction here, eh? Before price breaks down? Just watch. Price is going down, 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 down. Then when it gets to the low, it sweeps it. It creates a small white candle, right? At
Yes.
least it did not just break down fully. Like it didn't just continue. After it came, it bounced small. You see this bounce? That bounce. This bounce was supposed to push price up to be continuing up, all right? But what did the
Yes.
sellers do? Sellers came into the market again to push price down. So that area is a high volume area. It's an area where sellers re-engage into the market. We mark out that area. One. Not all setup have reaction area. Some setup will just have origin point, no reaction area. Okay, just origin point. All those ones, you just mark your fair value area, you mark your origin. This is the daily fair value gap. Let me use another thing to indicate it, because I want you to be seeing the fair value gap on every time frame, so that your mind will be showing you like a map where the fair value gap is. Good. Now this is daily fair value gap here. Don't forget to. But under the fair value gap, before price broke down into this fair value gap, what did it do? It did small rejection or reaction from here. So now, as price did this, it broke down again. These are the two places. Now, let us imagine this one has not happened. Alright, this one has not happened. I hope you are following me.
Yes.
Yeah, when you can ask your questions when I'm done, or as you will be watching the video, you can ask your questions. I'll be here to answer you. Then you can also follow up to tomorrow and this week of live market, so you can start seeing it firsthand. Now let's imagine this other price action has not happened. Price broke down and then it now created this reaction. That's the first place you can retrace back to. And also there's this origin over here, which is the beginning of the move. All right, good. Now you would expect that normally, as price don't do like this, one, two, then break down, you would expect that maybe it should come here and continue. Sometimes it's not even go this far to the origin. It will just come to the reaction area near the fair value area and it will continue. Now, in that continuation, what you are looking for is the creation of a fair value gap. You understand me? Of a new fair value gap. In this case, price came to the reaction area or the reaction POI or the fair value area point of interest, tapped into it and created new fair value gaps going down. Now let me take this off. Do you see the fair value gaps that were created after price came into this place? Look at here. That's a fair
Yes.
value
Yes.
gap. Good. Even here like this. That's a fair value gap. Even here like this. Once there's a gap between three candles, once there's a gap between one, two, three, that's a fair value gap. So price quickly did what? Created this multiple fair value gap. When I saw this, I knew if I wanted to start choosing any fair value gap, I will be failing, because price may be heading for this one up here and I'll be trying to trade this down one. If I sell here for market to go down, you see it kept buying, it kept going up, it kept
Yes.
going up until it reached here. When it got here, it now created only one fair value gap here. Let me show.
Okay, I see it.
You have seen it,
Yes.
right?
Yes.
the gap there. You see, right? So now
Yes.
price did not come all the way to this origin. What did price come to? Price came to this fair value area, the line, because that's the two places price can retrace back into in a 4-hour structure before it can continue lower. And to continue lower, what are you expecting? You are expecting price to enter this reaction area, fair value area, or origin area, and immediately price enters there. In the next couple of hours, you want to see price create what? A new fair value gap continuing in that direction. Okay, so when price, delete this, good. So looking at this now, as price came up, broke down, this became fair value area. It came up, broke down, this became fair value area. Now current price action, price has come up, it has broken down. This is our new fair value area, as you can see. And this one has a reaction, all right? Obviously, you can see the reaction yet. Can you see it? Let me show you. Now, when price came down from here to here, hmm, it's brought back up all the way here. What did he do? He came down to this low. You can see these 2 or 3 white candles. He came back to this low.
Yes.
He did not break it. It swept it. But what did he do? He came back up like this. Normally, this move after sweeping is supposed to continue going up, but he couldn't. Instead, what happened? Seller stepped into the market and pushed price down again. That made it 4 years. Right?
Yes.
What does that tell me? That tells me that this area, reaction area, could be our next area where price continues selling from. Okay, price can continue selling from here. So what will I now be waiting for? Very simply put, I'll be waiting for price to come into this place, create a new fair value gap going down that I will enter from, and then the price continue going down, because that will happen here. Now let me delete all this. See, when it happened here the first time, price tapped into this reaction area because it is the area before the break of structure, or the shift of structure, or the continuation of structure. Now let me quickly indicate something. These are 3 phases of the market. We have impulse, we have impulse, we have retracement, we have break of structure. Okay, we have retracement, we have break of structure, we have retracement, we have break of structure, we have market structure shift. Okay, market structure
Okay.
shift. After this session, I may introduce you to one of the videos that will just quickly touch market structure. All right, so you can start to be seeing this structure as good as you can be seeing fair value gaps as well. If price breaks below a short-term low, all right, that is a potential market structure shift. It means the market probably wants to continue going down like this. Okay, okay, that's what it probably means. So now, looking here, after price created this reaction area, traded into it, fell back down, it created different fair value gap that I didn't know which one to follow. So what did I do? I waited to see what price wanted to do. Price bought back again into this high, and instead of creating multiple like he did here to confuse and manipulate, what did he do? He created just one fair value gap here, as you can see, right?
Yes.
It is that one that I followed. This is my trade here. And how do I tell you I trade? When I spot my fair value gap, I take my Fibonacci tool, I measure the high of the Fibonacci all the way to the low of the third candle for a sell market. Okay, for a sell. But if you are buying,
From
imagine you wanted to buy for
from
a
on
yes,
sorry,
speak to me.
you mean from high of the first candle with the fair value gap, right?
In a bearish market, when you want to measure the bearish Fibonacci, you measure the high
Yes.
of the first candle to the low of the last candle, the third candle, to measure
That's the third candle.
a bearish Fibonacci. Now, if you are right, you will see that the high we have number 1, that's the beginning point,
Yes.
and the low we have number
Yes.
0. You can see it here, 1 here,
Okay.
0
Okay.
here.
Yes. Yes.
Yes, this is the 3
Yes.
candle: black candle 1, black candle 2, black candle 3. See the low I put,
Yes.
you can see,
Yes.
you can see where I put
Zero
it.
point that
Yes.
5.1.
Then where is our entry going to be? I say I like taking this 0.704, right?
Okay.
And that's where I put my entry. In our last video, I opened the Fibonacci for you to see the settings. I'm going to do it again here because I said that was what I'll talk about it as well.
That I don't have the last video, so I'm unable to like
Yes, you're
watch
able
both
to
video
set
now.
it up. I understand. It will be easier. That's why I'm doing it here too. So this is,
Okay.
let me open the Fibonacci. This is the Fibonacci setting. Let me quickly touch it because I've got it. When you get the video, you can make a screenshot and synchronize your own or modify your own to this. All you need is 1, 2, 3, 4, 5, 6, 7, 8. 8 boxes to be ticked. Then one of the boxes should be 0, 0.618, 1, minus 0.27, 0.704, 0.5, 0.79, and minus 0.68. You make sure you give them different colors, or you can copy my colors. How to change the color is you open it, you can see different color, you tap on it to change. You open it, different color, tap it to change. Moving down, you can see the settings that I put on. I put off background, I put off reverse, I put on prices, and I put on levels. The levels should be on values or percentage, depends on what you like. I prefer values. All
Okay.
right. uh the labels, I shift my labels to the right and I put the text in the middle. All right, this is labels. The labels, I shift it to the right and I shift it to the middle. The text, I shift it to the center and I shift it to the middle. And that's that on Fibonacci. How to draw the Fibonacci
Okay.
is when you are drawing the Fibonacci on a bearish structure, you are drawing from,
Based on
yes, high to low. Bearish structure or bearish fair value gap or anything bearish, you are drawing from high
bearish.
to low, high to low,
So
high to low.
let me even jot this one into.
Yes, let me quickly write it somewhere, or let me just, okay, let me write it somewhere. Bearish Fibonacci, bearish Fibo. You
Yes.
draw from high to low. Bullish Fibo, draw from low to high. So have you been able to finish writing it?
Yes.
You're done.
I'm done.
All right, good,
Yes.
good. So now, as I was saying, I take the 0.704 level. I take that level and I protect the high of the third candle or the entire high. But I like protecting just the high because if price goes to the high of the third candle, that trade is not supposed to, it's not meant to work out. It's not meant to, it's gonna lose. All right, it is not meant to go at that period. It's either you were right on your, you were wrong on your analysis, or you were wrong on your entry, or the market was just, being the market, or just being flimsy. Good. So that is that about Fibonacci. Very simple. What are the 3 steps to catching a trade. All right, let me quickly write it here. 3 steps to catching a trade. Step 1, spot daily FVG. Step 2, spot 4-hour structure. Step 3, identify fair value area, reaction point, or origin point. Step 4, wait for new 4-hour FVG continuing in your direction. Step 5, draw a feed on the FVG, take the 0.704 level. I said three steps, but it's actually 5 steps.
I'm done.
You're done.
Yeah.
Good. That's very good. So these are the 5 steps. I want you to open your chart tomorrow looking for these five
Okay.
steps. First, you identify your monthly high, your monthly low, your weekly high, your weekly low. That one is to enable you to see where price is potentially heading to. But these are the 5 steps to catching a trade. Just catching a trade. Now let us do 5 steps to identifying trend. To catching a trend. Number 1, identify 2 short-term highs or short-term low on the daily time frame. Number 2, identify opposing ITH or ITL, which is intermediate term high or intermediate term low. Number 3, identify fair value gap going your direction. This catching a trend, these 3 steps, when you're done writing it, let me know so that we'll go over it and we can easily call it a day. I make a I make the edits to this video, send it to you so that you can reflect on it and you can start seeing it on your charts quickly.
Yes.
Because basically
I'm done.
you are done. Alright, basically this is everything you need to do. So now, like I said, 3 steps to catching a trend, yeah, is to identify two short-term high or short-term low on the daily time frame. So if I say we should do that now, we go to the daily. If this trend was bullish, or if this trend, this US 30, if it wants to shift
Yes.
bullish now and start continue buying, what I want to see happen is that on the daily time frame, I will be able to identify two short-term low, okay, because it wants to start buying now. You understand? So I want to be able to identify two short-term low. Maybe price creates a fair value gap, it taps into it, create another fair value gap. Once that fair value gap is created, I know that okay, price has created two fair value gaps, which is two short-term lows. Yes. Now, what is going to be our opposing ITH or ITL? It is going to be this high, okay? Because look at this. When price creates two short-term highs, the opposing internal the opposing ITH or ITL might become the liquidity. Do you understand me? Now, let me explain it. You see, this before this big sell started, what was price doing? Like I said before, price was creating short-term lows, abi, short-term lows. This is the ITL because it is the beginning of the move, all right, of this bullish move that is going up, as you can see. But on the daily time frame now, what the price do? Price now created two bearish fair value gaps, fair value gap 1, fair value gap 2. That tells me now price must be heading in towards this low to come and sweep it because the trend has changed. Okay, once you see two short-term highs on the daily time frame being created, it means the trend has likely changed and the intermediate term low is what? Targeted. This is the formula for it. Two short-term highs is equals to target intermediate term low. Two short-term lows is equals to target intermediate term high. Now, what is, let me just quickly put it there, short term high? Do you understand it?
Okay, I think I get what you mean by
You
two
get what?
short-term high.
Yes, that's what
You
I've been
say value
explaining
gap
here. Yes,
inside.
when you have two
Yes.
short term
I
highs,
understand.
it means there's a fair value gap
Yes.
inside the high. You understand?
Yes.
Yes, a high with fair value gap inside. That is the meaning of a short term high. So when you have
Yes.
two fair value gaps, two highs that have a fair value gap, it means the intermediate term low, which is the ITL over here, is being targeted. So you want to start looking for sales into that low. Now, if price all of a sudden maybe it doesn't get to this intermediate term low, it now creates two short term lows, which means it has started let me write it there, bearish, because it will help you understand your bearings.
Okay. Let me jot it down first.
Yeah.
I'm done.
You are done?
Yes.
All right, all right. So, like I said, sure, you know what an intermediate term low is. If you look here, you will see the name,
Yes.
you will see the tag,
Yes.
intermediate term low. All
Yeah,
right.
I know.
If you look up here, intermediate term low. Why is this intermediate term low? Because if you check, there were two short term lows away from it. You can look at this one. This is a short term low because it has a fair value gap in it, and after that, another one
Okay.
was created over here because there's a new word. You can see the two fair value gaps, one here, one inside here. So immediately this two was established, I just know that this high here will be targeted and price may continue buying from there, as you can see.
Mm.
So this one was created one, this one was created two, and then this high did not hold. Price traded above it. Then what did it do? Continue buying, continue buying. Now, price created two short-term lows by creating this fair value gap, one, creating this fair value gap inside here, two. So what does that tell me?
Yes.
Price may want to continue going down. And what did it do? It continued going down. So it might it might continue all the way down to here. All right. It could continue all the way down to this low to sweep it and then pick up and continue going up, or it can just reverse and be a bearish here entirely. Or on the other hand, it can also do this. Maybe come down, doesn't get here, and then start going up. But immediately it creates two short-term lows for me. I now understand that this intermediate term high may become targeted and the market is now what? Bullish. But that's what this code says. This code says by the time you see two short-term lows created on the daily time frame, the intermediate term high becomes a target and the market becomes what? Bullish. What does the first code say? By the time you see two short-term highs being created, the intermediate term low, which is this low right here, becomes the target, and then the market becomes bearish. Now, let me teach you positioning and management of a trade. I've already spoken about positioning, how to position using the Fibonacci. All right, I spoke about
Yes.
it previously, the Fibonacci
Yes.
level to use, and I gave you the Fibonacci this thing, and I told you where to wait. Once you see price break below that, I told you, I mentioned impulse retracement break. Abi, this place
Yes.
right here, the neck,
Yes.
is the break. Now this is impulse, it
Yes.
retrace again, it will break. Whenever you see a break, what you'll be waiting for is for price to either come to the origin, one, or come to the fair value area, which is this break, two.
Okay.
Yeah, fair value area, or even beside this fair value area, if it has a reaction. I explained what a reaction could be when price consolidates, when price does not immediately just break the low like this. Now price does not break the low. Now this one does not have a reaction. Okay, this is just fair value and origin. Okay, and let me draw one that will have reaction. Now see one pattern that can have a reaction: break down, break up, all right, break down, a breakup, and now instead of just totally breaking down, it does something like this. All right,
Yes.
then this is the reaction. What I mean by reaction is it was not a smooth breakdown. It didn't just go down. Maybe when coming here, it went back up a little bit before it now finally break. So now in this scenario, What you will have is origin, we have fair value area, and we will have reaction point. Now, what does it tell me? In this first one, hmm, price can just tap into this fair value area, create a 4-hour fair value gap that is going down. hmm, Create a fair value gap that is going down, tap into the fair value gap, and fall. It is in this fair value gap you will position, and in the move down, you will make money. Price can do this, or it can come up. It's not this fair value area, we not hold it. If you tap into the origin, create a fair value gap, and fall down. Okay, you will also make money here.
Yeah.
Those are the two things that price can do. Now, when a setup has fair value area, reaction point, and origin, price can do one of three things. Like I said, it can either tap into the fair value area like the last one, come up, tap into fair value area, create a 4-hour fair value gap, fall. It can do that. Price can come up, tap into this reaction, which is what happened in this trade here, over here. You see, it was a reaction. Price did not get to this
Yeah.
high. This is the look at, just watch. This is the break. 1, 2, 3, 4. You can see this is the break. When it came here, it created this small reaction and broke down. All right, it was not a clean break. If you look at this one between this break, you can see that it is a clean break. There is no reaction. It just broke all the way down to here. All right, but here, before it broke, it came down, created. On our next video, we touch more on spotting these structures well. We'll be spotting each
Yeah.
structure with their reaction point, origin point, fair value area. By the time you have now understand how to spot out structure, it will be a problem for you. And when you keep on watching this video, you will also come to
Yes.
like understand it more. So look at this. Up, it tapped into this break, into this neckline. It did not go down, it rejected. That rejection is a reaction. It rejected, it went back up, then it broke. What the price now do? Price came back into that rejection. What the price do when it came to that rejection? It created a fair value gap, but the fair value gap did not hold. It fell back down. Then what did it do? It came back up again to the rejection or reaction point. Then it created another fair value gap, only one. This one was multiple fair value gaps. So there was confusion here. But when price came back, created one fair value gap, it tapped into it and sold beautifully, as you can see. So coming back here now,
Yeah.
when a setup or a structure has reaction point, origin point, and fair value area, price can take the fair value area. What you are just basically waiting for is for a new 4-hour fair value gap to be created downwards. Alright, when price get there, you'll be waiting. You're still waiting, you're not doing anything. If price decide that it's not using this one, it now come up and buy into this area, you are still waiting, you're not doing anything. If it does not create a fair value gap in the reaction area, you are still waiting. When price now gets here, it will create a 4-hour fair value gap. If it doesn't, it will break it. And when price breaks it, no problem, you will chill. You will now go to your daily time frame. Okay, structure has failed on the 4-hour. Why? Is price reversing? Is price now creating new short-term lows to the upside? You will check. If price has created two short-term lows to the upside on the daily time frame, that means the market is probably starting to reverse and start buying back up. You understand? So sales will now start failing. Then you will now start looking for what? This same setup, but inversed in the opposite way. Do you understand me?
Yes.
Aha, that's how it's gonna be. So instead of you to now start looking for sales after on the daily time frame, price has created a this thing. What you will now be looking for is buys, this kind of structure, break. All right, break,
Yes.
or it does something like this before it breaks again. It will do some kind of funny reaction, then break. This reaction point, if price comes back to it, price can continue, or price can come lower, continue, or price can take this break and continue. That's basically, you understand, how to consistently catch a trade in following the trend. That's how you consistently catch a trade in following trend. So if you have any questions currently for what we've spoken about, you can ask me. But if you don't and you believe when you rewatch this session you will have questions, then
Definitely.
yeah,
When I watch the section, I will have a lot of questions.
yes. So then I'll be able to address your questions with answers. Do you understand me?
Okay.
All right. So I'm going to call it a day now, so that this session is not too long and
Long.
voluminous. It's been about an hour and a few minutes already, and you will get this video this evening. I'm not gonna let it go past evening, so you
This
get it this
this
evening.
evening,
Yeah, you get it this evening.
okay.
All right.
Because I was about to ask when I'm going to get the video so that I can watch and see to my own
Yeah,
analysis as well.
yeah. You get it this evening, so that you'll be able to what you need to do from the video. You set your Fibonacci.
Yes.
The Fibonacci, you take a screenshot and you set it on your phone, and you follow the due processes.
Yes.
All of these guidelines, you follow them as well, and you'll be fine. Between now to the nearest period of time, replicating just this system, your analysis
Yes.
insights will open, and at least you'll be able to make money from these setups. From Because look at this, this was a very clean and beautiful move, really. This was like, I just tapped, you can see the candle went, tapped into it, and it started falling. And that was very clean, as you can see. So that'll be all for today, bro, and I'll see you again on the next one. All right.
All right. Thank you.
Perfect. Thank you. Yeah.
Okay.